So we are now going to quickly talk through some common documents and records in the revenue process. Some of these you may be familiar with, some of these you may not be. First is the customer sales order. Okay, so the customer sales order is just a document that is going to show the order that the customer placed, right? So the customer wants these items 1, 2, 3, right? And this is the quantity they want for each item. And it might have their desired purchase price as well. Like, this is the price they are expecting to buy it at. So it's basically just a record of the order. It is happening early on in the process. It's before shipment, it's before billing. The credit approval form is going to be used by the credit department when they are determining whether or not typically a new customer is credit worthy. So think of this as like you kind of applying for a credit card, and they have to check your credit to figure out if they want to advance any credit to you and how much credit they want to advance to you. So companies will go through that same process when they are vetting customers to see, what level of accounts receivable balance they're comfortable with a customer having, right? Some customers, I may be okay with them having up to $10,000 worth of AR. Other, like a big customer like Home Depot, maybe I'm okay with them having $10 million worth of AR sitting there. So it's that type of thing. And you're also going to think about what credit terms you'll be okay with them having. Like, do I want to make sure they pay within 30 days? Or again, if you have a big customer like Home Depot, they'll often get preferential terms like 60 days. They just have to pay within 60. All right, the open order report is just a system report that is going to list any customer orders that have not yet been fulfilled. The shipping document, I think you guys are very comfortable with that at this point. So the shipping document or the bill of lading is just going to accompany goods as they are being shipped out, and it's just the record of the actual shipment going out the door. Most of you, if you're buying things online, like through Amazon, you will get like a shipping document or a packing slip in there. So this is very similar. And I'm saying down here, I think we've talked about this before, but it's really nice for us as auditors when we're going through and getting a paper trail and testing some of these documents. Most of them tend to be just internal company documents, but what's really nice is if we can get some sort of third-party document, and sometimes with shipping documents, we can get the third-party version of it because some companies do outsource their shipping to like a UPS. So Amazon, again, would be a good example of it. So if you were testing their controls, or if you were even testing their revenue process, right? And you were going through and testing some revenue transactions for their shipping documents, instead of having to rely on any kind of internal Amazon shipping document, you could just get the tracking numbers and look up like the UPS or USPS tracking numbers, and then you could kind of get the external third-party validation from UPS to see that, yes, this item actually was shipped and went out, along with the internal document. Right? It's kind of like that extra validation. The sales invoice is the customer's bill. Right? I'm sure we've all seen some invoices in our time. So this will just tell the customer how much they owe the company for the goods or services, how much they're expected to pay. So it should have the items they bought, prices they bought them at, quantities. And the sales journal will just be this kind of like the sales subledger. It will list the items as they are recorded in sales revenue. That's as opposed to the AR subledger, which is recording items as they are recorded in the AR subledger. So they should be kind of opposites of one another, except obviously sales is just accruing over the course of the whole year, whereas AR is the point in time, right? Okay, customer statements are the periodic statements that we'll mail at the end of every month or at the end of every quarter, telling a customer what their balance is. So, okay, if this customer in this particular month got 3 things shipped to them, it would list those. They paid $5,000 towards those 3 shipments, it would list that $5,000, and maybe they had 1 return, so it would list that. So it will accumulate all those transactions in the statement, and the customer can look at that and verify that it kind of matches their records. Aged trial balance of AR. So I know on this slide we had the AR subledger, right? So that should list things that are currently outstanding in AR. But here we have the aged AR trial balance. So that's a little different. It will show the amounts in AR also, but the main difference here is it lists all the items in AR, right? So it has customer A, B, C, D, right? So on and so forth. But then it will have columns for basically if the AR is current, so within 30 days. And then it will have if it's 60 days old, 90 days old, and then there might be like 180 days, or it might just be 90 plus days. So basically it shows the age of the AR. And the goal here with the age trial balance is people look at how it changes over time and stuff like that. And we'll look at this later on too when we get to the substantive testing. But the idea is you want to compare how much is current, right? So if 95% is still in the 30 days category and you only have, 1% of your AR sitting in 90 days and older, then you're probably in pretty good shape with your AR. Versus, okay, if somebody comes this year and is trying to audit your books, and all of a sudden you have 50% in the 30 days or less, and like 20% is in 90 days plus, then clearly you're having a lot of collectability issues in this current environment, and that would definitely be cause for concern. And remittance advice. So remittance advice is this part of the bill that will be returned with the customer's payment. And I actually have one to show you. I blacked out all the good stuff. But this is a bill, right? So this is an invoice, an example invoice from good old LabCorp. And at the very bottom of the invoice is the remittance advice, right? So they send these bills in the mail, and then what they expect you to do is to tear off this little part at the bottom. Okay. And then along with your check, you are supposed to stick this in the envelope back to them when they get it back. It helps them match up your actual payment, cash money, with your identity, because it has information on here like invoice number, right? And the date and your name. Okay, you guys get the idea. So that was our remittance advice right here. Moving on, we have the cash receipts journal, right? So this is when all the remittance advices and checks that go along with them are actually received by an organization. Then they will be recording those cash receipts in the cash receipts journal. So this is another kind of subledger. And then we have credit memos. So credit memos are going to be issued whenever we owe a customer money. And typically we'd owe a customer money. Number one reason why is because they returned goods to us. And it could also be because goods were damaged in transit, something like that. But whenever that happens, credit memo has to be issued. And hopefully, again, a control we'll probably learn about later is credit memos should have a good authorization process in place. And last but not least, we have write-off authorizations. So write-off authorizations are going to happen when you have an account that is so overdue that you decide it's uncollectible. So thinking back to our AR aging discussion, maybe I have something over here that it's, you know, over 360 days overdue, and I just don't think it's collectible anymore. Or you could have something that is, so we could say like over 365 days is one reason why you might write something off. It could also be the company, you know for a fact that the company that owes you money has gone bankrupt. That's another great reason to write off AR, because you know for sure that that is never going to be collectible. So when you're writing those things off, again, you have to fill out this form, because this is another control that's going to be in place so that the write-off can be formally authorized, okay, and approved. So this is kind of an authorization approval type control, the idea that these forms are going to be in place so that every write-off will be approved. Otherwise, basically, you could just be writing off whatever you wanted, and you could be potentially writing off, you know, fraudulent transactions, which we wouldn't want that to be happening. So this slide just summarizes everything we just talked through, these sort of major functions within the revenue process. So the order goes into the system, right? The customer calls up and is like, hey, I want a bunch of hand sanitizer. The order goes into the system. Their credit is authorized. The goods are shipped out. Then we are going to bill them for those goods. Then hopefully our credit authorization process did a good job, and they are going to pay us for the goods, right? We're going to get that cash receipt. Once we get the cash receipt, we can relieve AR, and hopefully throughout all this process, we are recording everything to the subledger accounts, and so all of this is going to be summarized in the GL at the end of the day. This slide just summarizes some key segregation of duties for our revenue process. And I won't talk through the whole thing because that would definitely send you guys straight to sleep. But what I will say is take a read through the segregation of duties chart and just keep in mind, rather than trying to memorize this chart, which I would not recommend, just read through and keep in mind this basic principle that we want to keep authorization activities, recording activities, and custody. We want to keep those activities separate. And if you keep that in mind, you'll see that the functions they have or show as being separated in this chart actually do make a lot of sense. So for example, we see something like, okay, the order entry process is separate from the credit authorization process, which is separate from the shipping process. And this kind of makes sense based on our thinking back to our basic principle, because the order entry process, that's a recording activity. The credit authorization process is authorization, right? And the shipping part of the process, we actually have hands on the goods there, so that's custody. So you can kind of go through each of these and do this kind of across the top and see where all of these functions lie and why it makes sense that they're all separate from one another.